Welcome back to Investing Talk Podcast.
Today we are looking at a company that has effectively rewritten its own destiny overnight. We are analyzing Palantir. And just to set the context, it is Tuesday, February 3rd, 2026. We're less than 24 hours out from a Q4 earnings report that has, well, completely reset the board.
Yeah, reset the board or just flip the table over. Because looking at the action this morning, this feels less like investing and more like a stampede.
It is definitely chaotic out there, but the narrative shift here is, it's undeniable. For years, the tag on Palantir was always government contractor.
Right, spy tag.
Exactly, black box. As of yesterday, those labels are officially obsolete. We are looking at what is arguably the most critical piece of AI infrastructure for the enterprise in 2026.
That is a massive claim. And I'm the one who has to pull a brake when the hype train gets going this fast. We have a stock that was already trading at a premium. And now, after this report, we're seeing multiples that would make a value investor, physically ill. So my mission today is to figure out, is this justified?
Right.
Are we looking at a fundamental change, or is this just mass hysteria fueled by AI buzzwords?
It's the trillion-dollar question. Can the fundamentals actually support this price tag, or is it pure euphoria?
We're going to find out. As usual, before we start, subscribe, like, and comment to this video to support the show. We really appreciate the engagement, and it helps us keep these deep dives coming.
We do.
Now, take me through the numbers. Everyone is screaming blowout, but what does that actually look like on paper?
Blowout might actually be an understatement. Let's just look at the top-line revenue first. So Palantir released their Q4 2025 numbers yesterday, and they posted revenue of $1.41 billion.
Okay, so $1.41 billion. Where was the street sitting?
The consensus was about $1.34 billion. So right off the bat, a significant beat. But the raw number matters less than this trajectory.
Okay.
That represents 70% year-over-year growth.
70%. Let's just pause on that. For a startup, 70% is great. For a company of this size, that's unusual.
It's incredibly rare, but here is where it gets interesting. Usually when a company scales, growth decelerates. It's just the law of large numbers.
Of course.
Palantir is doing the opposite. If you look back at Q3 2025, they grew at 63%. Now Q4, they're at 70%. They are accelerating as they get larger.
That's the anomaly. That's the thing that shouldn't be happening. And looking at the guidance you sent over, they don't see this stopping.
Not at all. For the full fiscal year of 2026, they guided for revenue between $7.12 and $7.20 billion.
And what was the expectation there?
The street was at $6.22 billion.
Wow.
They basically told the market, you are underestimating us by $1 billion.
That gap is the widest I've seen in software this year. $1 billion miss by the analysts. But let's dig into where this is coming from, because the old bear case was always, they just rely on the Pentagon.
That argument is dead. It's buried. The driver here is U.S. commercial revenue. It is up 137% year over year.
137%. So more than doubling.
Doubling and then adding another third on top. They hit $507 million in U.S. commercial just in this quarter. Now, the government side is still strong. It's up 66%, but commercial is catching up fast.
So this is corporate America finally waking up.
Yes.
But why? Why now? AI has been a buzzword for 3 years. Every company has an AI strategy. Why is Palantir suddenly capturing all this spend?
No, this is specific to them. It's the AIP factor, the artificial intelligence platform. But it's not just the software, it's the sales mechanism. We have to talk about these boot camps.
I've read about these. This is where they send engineers instead of salespeople.
Precisely. Think about the old way enterprise software was sold. Sales guys, steak dinners, slide decks.
PowerPoint promise.
Exactly. Palantir completely flipped that. They said, we're not doing the dinner. Instead, they send actual engineers into the client's office for a 1 to 3 day boot camp. They take the client's actual data, real-time, messy data, and build a working use case on the spot.
So they bypass the promise and just show the proof.
And it collapses the sales cycle from months to weeks. You can't argue with a working prototype that's already running on your own data.
It's the try before you buy model.
Yeah.
But for a massive enterprise.
And they're backing it up. They said they saved $30 million in the first half of 2025 just by using their own software internally.
That's a strong calling card. Buy what we use. But I want to pivot to profitability, because high growth usually means high cash burn. Are they spending a fortune to get these contracts?
This is the most shocking part of the report. In software, we track something called the Rule of 40.
Right. Walk everyone through that.
It's simple. You take your revenue growth percentage and you add your profit margin percentage. If the number is over 40, you are considered elite.
Right. It's a trade-off. You're either growing fast but losing money, or you're growing slow but printing cash.
Well, Palantir didn't make a trade-off. Their Rule of 40 score for Q4 was 127%.
127. That
Yep.
breaks the scale. That's mathematical nonsense in a standard model.
It's unheard of. They are hyper-growing and hyper-profitable at the same time. Net income was $608 million. A year ago, it was $79 million.
That's nearly an 8x increase. And what about debt? Any leverage?
Zero debt. And they are projecting nearly $4 billion in adjusted free cash flow for 2026. They are self-funding this whole thing.
Okay, the fundamentals are undeniably strong, I'll grant you that. That rule of 127 that's the mic drop of the report. But now we have to pivot to the charts. A great company can be a terrible stock if the price is wrong. So pivot to the technicals. What happened when this print hit?
Euphoria, pure and simple. The shares jumped about 10% almost instantly in after hours, but you have to look at the setup. Before this, the stock had actually pulled back about 12% from its highs of $147.
Which, in hindsight, looks like a classic bear trap.
It was a prime entry. Analysts at William Blair had flagged that pullback. If you bought that dip, you're sitting very, very pretty this morning. We're now pushing into a price discovery range, somewhere between $194 and $223.
Price discovery, meaning we're at all-time highs. There's no historical resistance, just blue sky. But are we overextended? What's the RSI telling us?
The relative strength index is interesting. It's hovering around 66.
And usually, anything over 70 is overbought, right? It means the stock is running too high.
Correct. And 66 is sort of the sweet spot. It means demand is incredibly high, but we haven't hit that exhaustion point yet. There's still room to run. We're also seeing a golden cross.
That sounds almost mythological. What is it?
It's where the short-term moving average, the 50-day crosses above the long-term, the 200-day. It's a classic signal that a new, sustained bull market is starting.
I'm also seeing a massive cup and handle pattern forming on the weekly chart.
It is. That's a continuation pattern. But what strikes me most is the volume.
I was looking at the tape. The block trades are huge. This isn't just retail investors.
No, this is institutional accumulation. When you see volume surge on an earnings beat like this, it confirms the big funds were waiting. Now that the numbers are out, they're chasing exposure.
So the big money is voting with their wallet. But let's see what they're saying with their mouth. Let's bridge over to sentiment on Wall Street. These analysts have had a rocky relationship with Palantir.
That's putting it mildly.
Has that tune changed?
It's a complete 180. It's almost funny to watch. Truist came out this morning with a buy rating and a $223 price target, calling it a best-in-class asset.
And Dan Ives at Wedbush. I'm sure he weighed in.
Oh, yeah. He didn't disappoint, slapped a $230 target on it. But his commentary was the real headline. He is projecting a potential $1 trillion market cap for Palantir in the next 2 to 3 years.
$1 trillion. That puts them in the same sentence as Google and Amazon.
It does. And it's not just him. Zacks is even ranking them alongside Micron as outpacing NVIDIA for gains in 2025. The narrative has shifted from, can they survive, to, are they the next NVIDIA?
Hold on, though. I have to play detective here. Amidst all this buying, we did see a sell order that caught my eye. Ryan Taylor, the chief revenue officer, sold about 12,000 shares. That's over $2 million.
I knew you'd bring that up.
Well, the guy in charge of revenue selling right as the stock pops. It makes me nervous. Is he cashing out at the top?
Context is everything. That sale was under a Rule 10b5-1 plan.
Okay, decode that for us. Sounds like legal jargon.
A 10b5-1 is a pre-scheduled trading plan. Executives set these up months, even years in advance. He didn't wake up yesterday and hit the sell button. This was triggered automatically by a computer based on an old schedule.
So it's totally irrelevant to the news.
Completely neutral. It's just financial housekeeping. The real signal is the 13F filings. We are seeing cluster buying from hedge funds. They aren't scared of the price. They're scared of being underweight.
So the whole narrative has shifted.
Fundamentally, it used to be government spy tech. Now the market sees it as the AI operating system for enterprise.
It's a re-rating.
It reminds me of the dot-com boom in 96 or 97. Not the crash part, but the infrastructure build-out, the CapEx cycle.
Right.
Everyone bought the chips from NVIDIA. Now they have all these expensive GPUs, but they need an operating system to make them useful. That's Palantir.
Okay, but we have to look at the other side of the coin. Because my calculator is screaming at me. We have to talk about the valuation.
The bear case. Let's hear it.
It is the elephant in the room. We're talking about a PE ratio that is, well, it's somewhere between 200 and 400 times, depending on the metric.
It is undeniably steep.
Steep.
Yeah.
It's vertical. And the price to sales is around 100x. Most software companies pray for 10x. The argument here is simple. This stock is priced for perfection.
Meaning they can't afford a single slip-up.
Exactly. If revenue growth slows from 70% to, say, 50%, which would still be incredible, the stock could get cut in half just on multiple compression.
That is the classic value investor concern, and it's valid, but here's the counter. Analysts are creating a new category for this. The Rule of 80-plus profile.
Rule of 80.
It goes back to that Rule of 40. When you have high growth plus high margins, standard valuation models break. If earnings compound at an 80% annual rate, that crazy PE ratio shrinks incredibly fast. You're betting they will grow into the valuation.
But is it a monopoly? Let's talk competition. You have Snowflake, C3.ai, and more dangerously, you have the hyperscalers, AWS, Azure, Google Cloud. Why doesn't Microsoft just crush them?
That's the fear, but the architecture's different. Palantir sits on top of those layers. They're the decision-making layer, the connective tissue.
Okay.
They integrate with AWS, they don't fight it, but the real moat is the switching cost.
Explain that.
Look, if a hospital uses Palantir to manage bed flow and schedule surgeries, that software is running the hospital. If an army uses it to position tanks, it's running the war.
It becomes the central nervous system.
Precisely. Ripping that out is a nightmare. It's not just moving data, it's changing how your whole organization works. That makes the revenue incredibly sticky.
Okay, customer retention is the safety net. But there's one more risk, execution risk. To keep this growth up, they're hiring aggressively. Expenses are rising. If the economy slows down, they're left with a very expensive headcount.
That is a fair concern. They're running a sprint right now, but that $4 billion in free cash flow we talked about, that's the buffer most growth stocks just don't have.
So let's move to the final decision, the verdict.
It's time to call it.
I look at this valuation and it terrifies me. Paying 200 times earnings goes against every discipline bone in my body. But I have to admit, the execution is undeniable. They are debt-free, printing cash, and accelerating at a scale that just shouldn't be possible.
Right.
The worst case is the stock corrects, not that the business fails.
And at the crucial distinction, based on that commercial acceleration, the dominance of AIP, and those off-the-charts Rule of 40 metrics, I'm giving this a bullish score of 9/10.
A 9 out of 10.
Yeah.
That is an incredibly high conviction score from you.
It is. The thesis is simple. Palantir has transitioned. They are a commercial juggernaut now. With 137% growth in U.S. commercial and that guidance, they are outpacing the entire industry.
So what's the strategy for someone listening? How do they play this?
This is a multi-year hold. The target isn't next week. It's the full realization of the 2026 earnings acceleration. That recent dip to $147 was the gift. The thesis is that AI needs an operating system, and Palantir is winning that race. You buy the winner.
That is the verdict on Palantir. It's expensive, it's hyped, but the numbers suggest it might actually be worth it.
Absolutely.
That brings us to the end. We've unpacked the earnings, the technicals, and the risks.
And hopefully made that PE ratio seem a little less scary.
Maybe just a little. As always, thank you for listening. Make sure you subscribe to the channel so you don't miss our next update. Because if this stock moves like we think it will, we'll be talking about it again soon.
See you next time.
Take care.